Final account of a sole trader. So a sole trader is someone who has a business, finances the business, and runs the business by himself. He makes the profits alone. He makes decisions alone. So that is sole trader. So today we are going to look at the final account of a sole trader. Now we have about the 3 accounts that make up the final account of a sole trader. First one is the trading account, profit or loss account, and the balance sheet. So these are the 3 accounts that make up the final account of a sole trader. So let's look at the trading account. Now, this trading account, like normally is account prepared by a business organization in order to ascertain gross profit or gross loss. So the trading account and the profit or loss account, they are professionally termed as the income statement account. Income statement, not income statement account. They are called income statement. So these are the 2 accounts that are professionally they are made together. After preparing it, you prepare them together. So they are professionally called income statement. So the last one, which is the balance sheet, is professionally called statement of financial position. So it's called statement of financial position. These two are called income statement. So, but let's look at them separately. Then from the trading account, like I said before, is an account that is prepared by a trading organization. It's an account that is prepared by a business enterprise. It's an account that is prepared by a commercial entity. So all these things I mentioned, they are the same thing. Commercial enterprise, commercial entity, business enterprise, business organization. So they are the same. It's just a change of terminology. Now we look at this. So it is prepared. The purpose of preparing the trading account is to ascertain gross profit or gross loss. So which means that as you are preparing trading account, the end result must be the gross profit or the gross loss. So when the balance is positive, it is gross profit. But when the balance is negative, it is called gross loss. Now let's look at it here. Trading account, from the definition, trading account is an account prepared by a trading organization in order to ascertain gross profit or loss during a particular period. Why the purpose of preparing profit or loss account is to ascertain net profit. So have you seen it now? As you are preparing the profit or loss account in order to ascertain gross profit, you are also looking at the net profit, because you must arrive at net profit when you prepare the profit or loss account. So the profit or loss account is the account that is prepared in order to ascertain net profit, which is the true profit. So the net profit will show you the true result of the business. So the net profit will show you whether the business is profitable or not, whether the business is profitable. Because the gross profit may not actually give you the entire result, the entire picture of the business. It will not give you the accurate profit. But when you prepare the profit or loss account, there we will be able to arrive at the true profit, to know how profitable the business you are doing is. So this is the purpose of preparing profit or loss account, to ascertain the actual profit, which is the net profit. Then we look at the balance sheet. The balance sheet, which is called the statement of financial position. So as usual, you know that balance sheet is prepared in order to ascertain the financial position of the entity, not to ascertain the financial position. So in the balance sheet, you prepare it to know the financial capacity, the financial status of the business. So from the balance sheet, there you will know whether the business is solvent or insolvent. Because in the balance sheet, it will disclose total liabilities, the total liabilities of the business, and the total asset acquired by the business. So the total asset the business possesses during the year, or the business possesses, and the total liabilities. So in the balance sheet, all of these items I mentioned will be disclosed. So that is where we know whether the business is solvent or insolvent. So from the result of the balance sheet, it will now give the investors, like from the result of the balance sheet will determine whether the investors will continue or to pull out of the business. Okay, now let's go down to the terminologies of profit of trading account. Terminologies of trading account. Okay, we have the opening stock. We have the opening stock. You can call it opening inventory. No, professionally you call it inventory. So the opening stock is opening inventory, while the closing stock is closing inventory. So we have opening stock, we have purchases, we have sales, we have carriage inwards, we have carriage outward, we have return inward, then we have cost of goods available for sale, we have cost of goods sold, we have gross profit or gross loss. So let's look at this. Let's look at this now. So the opening stock, as we talk about opening stock, we are going to define the opening stock from here. So opening stock, this refers to the total quantity of goods available to the business at the beginning of the accounting period. So the total quantity of goods available to the business at the start of the accounting period, that is opening stock. So it means that in the beginning of the year, the quantity of goods available, the quantity of goods which the business will sell, like the quantity, you know that in the beginning of the year, or let me say at the end of the year, when the business is closing the stock. So those leftover stock, they are called closing stock. Now, when the business resumes, maybe like when the business resume later, so those closing stock will now they automatically change to opening stock because they are the quantity of goods available at the beginning of the year. So that closing stock of the previous year will now automatically turn to opening stock because they are the one available which the business will start trading with before they start making new purchases. So the quantity of goods available in the business or the quantity of goods available in the warehouse with the business or with the company we trade with while they make new purchases, they are called opening stock. Then we look at the purchases because you know that because the quantity of goods they have to buy more because the business is all about buying and selling. So buying and selling, the company will have to buy more in order to sell, in order to make more profits. So therefore, the company will go and purchase another goods. So which means that the purchases that is where the purchases comes in. So purchases refer to the quantity of goods bought by a firm for reselling. So it includes both cash purchases and the credit purchases. So purchases is the quantity of goods which the company bought for reselling. So they purchase it for reselling. So the purpose of buying it is to sell, not for using. So therefore, in these purchases now, under these purchases, we have actual purchases which is called net purchases. Because during the purchases, there may be some items or may some goods which are below the standard or like those substandard products, or let me just those goods that are maybe some which might damage on the, so those ones will be returned to the supplier for you to arrive at your actual purchases. Because when you purchase item and you find out that some of the items that you purchase, few of them are not good or they are not what you ordered for, or they are not they are below the standard, that is the substandard product. So you have to take it back for the company to do maybe to change it. Or so when you return it to the company, back to the company, you have to deduct the amount of those goods that you are returning. So when you return it, you minus it for you to arrive at the actual amount of goods that you purchase. That is called net purchases. So which means that the net purchases is the purchases minus returns outward. It will give you net purchases.